guys, it's Helena McDermott with the Evolve Real Estate team with Keller Williams, and I'm here with Angela Dibblee, financial advisor with Keith Wealth Management. So we're going to chat today about some solutions for home buyers. I know it's been challenging in this market. People are wondering how to save, where to save, and really maximize on those savings because it's tough out there to save up for your first home right now in the changing market. So welcome, Angela.
Hi, Helena. Thanks for having me.
My pleasure. All right. So first, maybe we get started if you'd like to tell us a bit about what programs are out there. What's the difference? I mean, there's so many different acronyms out there. I know it can get a little confusing. So
it can get a little confusing, yeah. And there are more programs now than there used to be. So I think in relation to maybe this topic or working on building your savings, probably the three programs that are out there that we should probably take a look at would be RRSPs. So that would be Registered Retirement Savings Plans. Most people are pretty familiar with them. Tax-free savings accounts. And the latest one is the first-time Homebuyer Savings Accounts. Okay, so when you say acronyms like RRSPs, TFSAs, and FHSAs. So yeah, it does get a little overwhelming. So RRSPs came first, and many people are familiar with them. You contribute to them every year. You actually you earn 20% of your annual income in room every year. Okay. And you get a tax deduction for when you make your contributions that you can use to bring down your taxable income. There is also, you can use room from previous years, if you didn't have chance to maximize that in previous years, but maybe as you get going in your career, you can actually go ahead and max those out later on. And there is some benefits for those. When you go to take out money from the RRSPs, they are going to be taxable. There's a couple of different scenarios where that's not the case, but we'll get into that a little bit later. The tax-free savings accounts, those are pretty popular as well. Again, you have to be over 19 in New Brunswick to get one. You don't get any tax deductions when you make contributions into those plans. However, you can put money in there and take money out without any taxable consequences, okay? And any of the contributions you make in there, if it earns some money, that's tax-free as well. And then we have the first-time homebuyer savings plans. So this is almost a blend of those two programs when you take a look at it. So you do get tax deductions when you make contributions to that first-time homebuyers plan. There's a cap on the amount you're able to put in every year and in your lifetime. But if you go and withdraw that for a qualifying home, if you qualify for that, for opening that account, and we can get into that later, but if you meet the qualifications for that and you have a qualifying home, you make the withdrawals for that home purchase, it is tax-free as well. So, and you can actually have that. You have to be 19, but you can have that until your age. You could be 71 and still have a first-time homebuyer savings account if you want. So those are the three programs I think in relation to building your savings towards a home purchase. That would be something that I would recommend people take a look at all three.
Wonderful. So is there one that's better to start with than others? Like, is it good to start with maybe the tax-free savings account and then move on to the first-time homebuyer account? Or
I guess it really depends on your situation and the age at the time. So one of the details with the first-time homebuyers account is it expires after 15 years, okay, right? So you have to either use it within 15 years or by the end of that 15 years, you have to either withdraw it, or if you work with an advisor, they can help coach you how you can convert that you can transfer that into an RRSP as well.
Okay.
So, it depends if you need a lot of flexibility as well. Tax-free accounts are great for any type of savings. So they're great for long-term savings or those short-term emergency savings. And there isn't any requirements, for making those withdrawals. So let's say, but you don't get the tax deductions either. And sometimes what I find, it just depends, if we don't have a defined purpose for a pot of money, let's say, it can get sidetracked or it can get steered off towards something else.
Like
Maybe
a trip or something.
Trips or an emergency,
yes,
what
absolutely.
if, you all of a sudden you need to buy a car or whatever it could be. So there are some definite more guardrails set up with that first time home buyers account. And some people really need some more structure where it's good for that. I will mention one of the aspects with the first time home buyer savings account that I learned is that, if you're a grandparent or a parent, you can actually make a contribution to an adult child's first time home buyer savings account.
Oh, it's amazing.
It is nice. Now the person who the account is named in gets the tax deduction.
So no
that
tax
would have been
deduction for
great,
parents,
right?
yeah.
But it is a nice way to say, hey, I want to gift you something and I know that it has to be for a specific purpose, right? So it's a nice, I think it's a nice feature to be able to do that. And again, you're setting up some guardrails. I know someday you're going to use this for your home purchase. I'm helping you with this. Maybe you want to, instead of waiting to leave something behind, maybe you want to leave something now and or it's going to be used for that in the future, or they can transfer it to RRSPs later on. Right?
Well, I'm thinking too, there's a lot of people that their kids might be living at home still. Maybe they're teaching them about money by them paying rent. I know there's some out there that we're putting that money aside or part of that money aside to help you with your with your down payment, because it is hard to get ahead right now. And so they could do that instead. So they could actually help contribute to this fund for their child.
It would be a good incentive. And I will mention that you're allowed to contribute up to $8,000 a year for the first time home buyers plan. If you can backdate it 1 year. So if you opened it 1 year, maybe didn't make it, like if you opened it in 2023 when it first came out, but no contributions were made, we'll say, and now you're into this year, you could technically backdate and put in the $16,000 in 2024, if that makes sense. You can only contribute up to $40,000 per lifetime, though.
Okay.
Yeah. So that is something to remember. But, any of the earnings, any growth that is earned in that account, that's tax-free as well.
So what about a minimum? Like, is there a minimum amount to get started with this that you need to contribute?
Not necessarily, no, because people could start with, a simple monthly contribution. It would depend on the company and the type of investments that it's in. But, it would be like any other registered savings plan. You could put in as little as $25 a month if you wanted to. Yeah. So it is easy for pretty much anybody to get started, at least. Sometimes you just need to get started. So yeah, and that can add up. And hey, if you earn money off of that, if let's say you put in the $40,000, it's worth $50,000, that is tax-free. And you're not affecting your contribution room by those extra earnings either. So
that's amazing.
Yeah.
So you said that there's some safeguards in place there, so the funds aren't as accessible, but still there if needed. But but be taxed on it if you didn't use it for a house. So I'm just kind of curious on that.
So yes. Okay. So I think first off, to qualify for this program, again, in New Brunswick, you have to be at least 19 years old. All right. And you have to have not lived in a home that you owned or that your spouse or common law partner owned at the same time they owned it within 4 years of opening this account.
So it's not really just for first-time home buyers then?
No. Okay. You can actually restart, your eligibility if you haven't owned a home. We'll say again, if you or your spouse that you are currently with haven't owned a home together, or they haven't. And yeah, you can restart that. So after 4 years, you could be eligible again. So it's not, just for people just getting started with their very first home. Yeah. So, so that has to be it. And it has to be a qualifying home as well. So, again, it's some examples of that would be, your standard detached home, mobile homes qualify, condominiums, apartment or like a duplex would qualify for that, a single family home, townhouses. So there's a full list on the CRA website of what actually qualifies for a home. Even if, let's say you weren't married, if you opened the account and you weren't married and you got with somebody after the fact, and even if they owned a home, when you opened the account, you technically were not, disqualified for this. So it really depends on everybody's situation. Like it's worth checking out if it's something you might qualify for.
Absolutely. I mean, why not take advantage of those tax incentives? And
it's an extra spot to put some registered money, get some tax deductions. Absolutely. Yeah. So
that's perfect. So the difference between the home buyer plan and the first home buyer savings account.
Yes.
So what is the difference between the two?
Okay. So the home buyer's plan is actually a program inside of the RRSP plans. So again, you have to remember RRSPs came out quite a while ago, and there weren't a lot of other programs out there for savings like this. What it is you are allowed to take out up to $35,000. That is the maximum limit for the home buyer's plan towards the down payment of your first home. Now, all the qualifications are the same as they were for the first time home buyer's plan, like that separate account. They kind of, again, taken that benefit and built a whole new registered plan around it. But the limit for that is $35,000. And the idea is that you have about 15 years to repay your RRSPs. If you don't, then you'll have to pay the income tax on whatever you haven't taken out, because we get income deductions when we contribute to our RRSPs, right? You go to withdraw those, you have to take that as income. However, through the home buyer's plan, and there's also a lifelong learner plan for, education. That's a separate topic. But they give you 15 years to repay that back. If you don't repay back what you withdrew, you have to pay income tax. You have to claim for income what you haven't paid back.
So they just give you that time to replace the funds by contributing.
Exactly. And you get a break on the income taxes. So you can actually use that plan in conjunction with your first time home buyer's savings account as well. So you could use the entire account that you have saved up in your first time home buyer's account and your home buyer's plan from your RRSP. You can use them together.
Okay.
So, yeah.
Because, I mean, there's people starting their careers out there that have employers contributing too and matching policies, so they have money tied up into the RSPs as well.
That's true too. Now, you don't get any deductions for what your employer contributes to your RSP. No, it would just be what you personally contribute. Yes. So that's another thing as well. Yeah. Again, talking to an advisor, helping go through that, they can help let you know what you qualify for specifically. Yeah.
Absolutely. Because every person's definitely going to have different scenarios and different plans that are going to work best for them. And that's what's great, having a professional like yourself to really sit down and look and tailor to their needs.
Yes.
Other ways to unlock money. So we have those 3 programs, and I know that's what we're mainly talking about today. But while I have you here, just wanted to ask, because I know
ask away.
In passing too, you were mentioning about unlocking pensions in some cases, and I'm like, wow, how does that work? Because I always think of like pension, like, ooh, can't touch it, like.
Yes, and we do have some clients in certain situations that they're, for whatever reason, they had an employer sponsored pension and maybe they've left, or and then they need some access to money, maybe for a down payment, let's say. So you are able to unlock pensions. And I'm just speaking to New Brunswick pensions right now, like just to make that clear, because every province has different pension rules. But in New Brunswick, you are able to unlock your pension for a few different reasons ahead of retirement age, which the age they use is 55. So some reasons would be if it's a really small balance and it's under a certain amount, perhaps they will let you say, okay, based on your age and the value of this account, you don't need to leave it locked in. You can go ahead, unlock it, put it into you can put it into an RRSP. There is a bit more to it than that, but essentially that's what you could do, and then you could access Homebuyer's Plan, let's say, through that method. I will say, just before I forget though, you are allowed to transfer your funds from your RRSP to your first-time homebuyer savings account too.
Okay.
So again, depends on what's best for you. And that would be specific to a certain person. So back to pensions, but so I know it's riveting stuff, right? So the other reasons people could unlock pensions would be if they maybe have a shortened life expectancy. Okay. And the reason that most people come, maybe they don't have a specific reason, but they just need access to funds. New Brunswick will allow you to unlock approximately a quarter of your pension one time in your life. You're not able to do it more than the one time before you go ahead and use it as income in retirement age. And they do that to try and make sure people are saving as much as they possibly can for retirement and not going through the savings. But essentially, long story short, you could unlock money in a plan like that specifically. Again, you'd have to talk to your advisor and use that, have it transferred into an RRSP, and then use that home buyer's plan, or you can simply take it out as cash. However, you'd have to claim that as income as well. So our goal is to obviously do it in the most tax efficient way possible.
Yes.
If you have a spouse, they have to sign off on it as well. And you do need to get it notarized by a commissioner of oaths or a notary public as well to do that. So there are a few steps. It's not instant. It's a bit of a process, but that is a service that is something that we do for people and let them know that they do have options that way too. So
absolutely. And I mean, and that's likely somebody that's later on in life that would be looking at that. But there's lots of different reasons people are buying a home, and it could be, not the first time, and life changes. So no, that's interesting that there's different ways to unlock money that I know I thought was a no-go until that. So wealth of knowledge right here. That's fantastic. While I have you,
okay,
your brain, I know that this comes up, and it's something I didn't learn actually until I got into the business, and it comes down to life insurance on a mortgage. So you sign your papers, and you need life insurance, and a lot of times people are just getting it right there at the bank, or at the time it's easy. Sure. They're already doing so many things in the home buying process and contacting so many different professionals.
Yeah.
Yes, exactly. That I find this is one piece that kind of gets missed, but I know there is different options on the life insurance policy. So when it comes to doing a mortgage.
Oh yeah, absolutely. And I think as long as your lender knows that you are covered for, the main concern obviously for them would be that what they're lending you is going to be covered is should you have an illness or pass away, right? So if you're able to prove that you have a policy that covers that, you could really have that from anywhere. And it's probably beneficial to have that maybe outside of the lender. If, again, you would want to talk to an advisor, typically, like a brokerage firm like us, we're able to shop around with any carrier and look for, different pricing, different policies that maybe would be more suitable to you. And it can also encompass not only replacing your income should you pass away if you have a family, especially young family, or your mortgage, the balance on your mortgage, or any loan that you might have. And what that does is you're able to name a beneficiary as well. So the beauty of insurance is you pay for it with after-tax dollars. So your beneficiaries are going to receive it tax-free, privately. It doesn't go through your estate, so it's not subject to any estate taxes, probate fees. You could leave it for a charity if you wanted to. But since we're talking specifically about mortgages, let's say it's kind of a standard situation, husband, wife, kids, that type of thing. They are able to set up a policy, and instead of just maybe for the mortgage of $250,000, maybe they have a policy for $1 million. Well, they have that policy, that face value never decreases. You have that same amount of coverage for the length of the policy, and your beneficiary, probably one of the first things they want to do is pay off the house, right? Mm-hmm. And make sure that they don't have any bills. But then they have full control of that money. If you are getting insurance through a lender, it tends to the beneficiary would be the bank or the lender. A lot of times the benefit amount decreases with the value of the loan.
That's what I was really surprised about, because I just thinking from my first mortgage, I was like, wow. So I'm paying, let's say, $20 a month. You see the premium right in your online. Okay. It's like, okay, that's what I'm paying. And then as my mortgage decreases, I'm still paying the same amount. And at the end, if something were to happen, disability, whatever, and there was only, let's say, $10,000 left on the mortgage, that would be cleared off, which is great. Excellent for my family. Great,
yes.
But I don't have the benefit of that full, let's say, $300,000.
Right.
That I could have had for the family that I've been paying. So it's just, what's a good use of my money?
Exactly. And again, just getting some different price points. The other issue could be, I would ask people to look into, is it a policy that the underwriting happens after the fact, after a claim is made, or are you getting fully underwritten beforehand? Is the insurance company, are they asking medical questions? And there could be a few hoops to jump through, albeit there are lots of companies out there that have a much more simplified process, and there's still good policies, good plans. Mm-hmm. There are some people who want a more simplified process, and that is something that can absolutely be accommodated, and they're great plans. But as far as looking after the financial security for your entire life and maybe your family, your mortgage is part of that, obviously. Mm-hmm. So it's one piece. And like you said, having that ability to your family being able to benefit from the full face value of that does give you more power in that sense. So I just recommend that people take a look at that. If you're looking at a home and what roughly your you would probably help people with that. What's your max? What range are you looking in? The bank is going to help you understand what you can qualify for as well. So that's all great. Shop around a bit. Talk to your financial advisor. We try to be a person that people can come to in between and all of the other experts as well. Because you're going to be dealing with a lot of people. You're going to be dealing with the realtors. You're going to have a lender. You're going to have a lawyer, right? So as financial advisors, we try to be the in-between of all that and help cover you for everything. We're trying to be that go-to person, help look at the entire picture, right?
Absolutely.
What happens if you pass away unexpectedly? You get sick. You get hurt. Right? Our job is to make sure there's safety nets set up in place for those unexpected events. The things you can't necessarily prepare for all the time. And unfortunately, they do happen. But that would be your advisor's job, is to help look at that and help make sure that you are protected against those things, but also to save for the goals that you do have and the plans you are aspiring to. So biggest thing would be home ownership and retirement. Those are the two things that people typically come to us about in the first place. So yeah.
Wonderful. No, that's great. Thank you so much, Angela. I just wanted to say that's your wealth of knowledge, and whether it's setting up a savings for your first home, second home, cottage.
Right?
Right?
Great questions.
I know when you buy houses, like it is a big thing that comes up, it should come up. It really should come up more about the life insurance piece, because it doesn't. People just sign whatever because they're dealing with so many people. They just want to get it done.
There is stuff
you don't
flying
think
everywhere.
There's stuff flying, so you don't really think about it. You're like, okay, that box is covered.
What do I got to sign?
What do I have to? And then they don't think about it that, oh, I'm spending this. But I'm not getting the full benefit of what I could for that.
Right.
The best bang for, I don't think they're getting the best bang for their buck. I mean, and I can't speak to every situation, but that's one thing I was like, wow, that's possible. I could do that. I thought I had to do it that way. So I think it's a common
misconception.
Yeah.
And I will say that not everybody qualifies automatically off the hop. Mm-hmm. So then that's a process, right? And that's an extra stressor. So
like, is it going to pay out, or
is it going to pay out, right? Or you know, like my husband he didn't qualify for this, or we couldn't get this. It's like, well, you still want that kind of coverage. Like most people want to be protected. Mm-hmm. It's like getting insurance for, you know, if you had a fire or, you know, vandalism, those types of things. Right. Yeah. You know, there are options out there. You don't have to just do it all in one stop. It does help to do a little bit of homework or contact somebody, ask them to help you. So we help people with that. Absolutely. But yeah, life insurance for sure. Critical illness, disability, unfortunately, is something that comes up more and more now. Mm-hmm. And one of the main stressors is if I can't work, if I'm sick, you know, I'm not bringing in an income, there's almost more, it's awful to say, but there's almost more hardship in those scenarios because maybe you did have life insurance. You're still alive, which thankful, yes, mm-hmm. But if you have nothing replacing your income, and if you're not on a group plan, like I'm talking to my self-employed friends and clients, it is really important to have something there. And those are the types of conversations that not everybody wants to have them, but that's our job to bring that up. What's your plan if, you know, God forbid that were to happen, right? So those are the types of things, like what's going to be bringing in the money to pay that mortgage, to replace your income, the bills, you know, you're going to need time off, or maybe you're just not able to work anymore, right? So again, we help plan for the unexpected and set up the goals for the expected things. So,
and even with those critical illness policies, I know the one that I've set up on, for example, it's also, I know how I felt, but it's like, okay, I know I need to do this just in case, but like, am I just throwing this money out the window if I don't need it? But there's actually savings that have a cash value.
That's a good point too. Yeah. So there is a way to set them up that if you don't end up using, you actually get money back.
And that's what I'm talking about.
Right. Right. Yeah. So it's not just, hey, I'm paying for something I'm never going to use. Hopefully, I hope I never have to use it. Exactly. But it's almost like an extra pot of savings for retirement down the road. Yeah. No, you bring up a good point too. So
it definitely made me feel better about that. Like, you know, at least it's like, oh, this is another savings, and they're giving me peace of mind if I do need it, being a self-employed
It's person. Another pot of savings. Absolutely. So
with the limited inventory we're seeing today, some people are looking at building homes. So is that something that you can unlock this savings for?
That qualifies as well for the first-time home buyers savings plan or the savings account. So you must have a written agreement to build a qualifying home. Okay. And it has to be, I believe, the The construction end date or the acquisition, again, this would all be on the CRA website, would have to be before October 1st of the following year of the withdrawal. So they do, give you a window of time. So if you're making withdrawal, let's say in 2023, you would have until October 1st to build the home the following year. So again, there's some timing, and there are some nuances with the first time home buyer savings account. It is still new. We're still learning a lot of the ins and outs of this. So we're keeping an eye on that. And you have to be a Canadian resident, again, over the age of 19 in New Brunswick. And you must not have acquired a qualifying home more than 30 days before making the withdrawal too. So there's timing issues. And that's, again, where it is a new program. Our industry is really just starting to become familiar with them now. Obviously, most people are just in the savings phases of these, or using them as savings vehicles. But there's going to be some nuances and windows for getting those withdrawals out and such. So if my recommendation, depending on the person, if you need flexibility and you don't necessarily need the tax deduction, and you're not sure when you want to start, if you don't have a savings plan right off the hop and it's your first time starting to save towards things, tax-free might be the way to go.
Where you don't have the 15-year time limit.
And you're not starting the clock.
And you could always move from that tax-free savings and be like, okay, I feel like I've graduated. I want to use this and move it here.
Exactly.
Because you've got a limit on that. Right?
Exactly, right? Because it does start the clock, right? It is a decent length of time, right?
Well,
15 years.
Most people have plans.
Right.
Yeah.
But hey, it took myself and my husband, it took us a while to get into the market. We rented for a long time, and part of it was just being able to accumulate those savings, right? Like we had kids and businesses and all kinds of things to spend money on. So it is hard, but once you get started and it's out of sight, out of mind, it's flexible, it's adjustable. Anybody can do it. So you just need a little coaching, maybe, or guidance on how much fits within your budget and where to stick it. Like you said, maybe the RSPs or tax-free savings is the place to start. A lot of people start with with RSPs. Most people had those because there wasn't really anything else. But it is slightly restrictive as well, right? You go and take it out, taxes get triggered, right? So Absolutely. It just depends on the person. So
well, and even that map that got published last week that
I love
we were
that.
talking about,
Yes.
I know it's really neat, and it puts into perspective that although it's been more challenging, we still are in an affordable area, and one of the most affordable areas in Canada.
Right.
So it said, on average, considering in like prices of homes, average income, and bills, that were 3.4 years for a buyer to save for that home. So it's people tend to overestimate what they can accomplish in 1 year and underestimate what they can do in 5, right? So that just goes to show, right? 3.4 years, everybody's situation is different, but you can really help tailor that to be, what can you afford with your current bills? What is going to be the best? Maybe it's just starting off with a tax-free, or it's a home buyer. Like, what are their goals? So
right,
you can really help tailor that, because starting to save, it's never too early to start to save. Never too early.
I tell my kids and and everybody, everybody, it's never too early and it's never too late. Yeah. So you just need to get started is all. So, and find something that fits within your budget that's livable for you, that you can just continue on with, and you're not going to feel impacted in your day-to-day or your week-to-week bills, right? So
And you could set it up so it's something that comes out, for example, like on your payday or
absolutely,
or things like that. So you don't even feel like you
notice it.
You didn't even get a chance to touch it.
Right, exactly.
I know for me, that's what works for me. It's like if something's automatically gone, then I'm like, okay, I never had it to spend it. But if I had to go and say, here, Angela, here's a check for, $100 a week to go towards the savings.
Right.
It would, it wouldn't make it to you.
Right, exactly.
But if you take it right away.
And so, I do get a lot of people, and they'll be, maybe something happens. Maybe the roof blew off, or,
that's happened a lot lately.
Right? Hey, Sussex. Yeah. So,
your husband.
Right? So, hey, maybe that happened. It's like, oh, yes, I have a savings. I have a tax-free savings I've been putting money into. And it's like, look, and it does. It builds quicker than you would think, right? Mm-hmm. So, it's having that comfort of having those pots of money and access to liquidity, right? So again, they're all great programs. This was an interesting one. It's almost that first-time homebuyer savings account. I hope it will help people get closer to their first home and contacting you. Or again, maybe there's people out there, depending on their situation, maybe they're starting over again, right?
Absolutely.
So it has some blending of that RRSP and that tax-free savings, which is pretty interesting, but it's very specific for its purpose. So talking to you, talking to an advisor, seeing what's the best fit, it will go a long way.
Wonderful. Well, thank you so much.
Thank you for having me
to chat with me on this. And well, you heard it, folks. Angela's got you covered. She's taking her client's best interest. I've definitely learned a few new things today, so I hope everybody else did. And you heard it. She's got you covered for every aspect of your savings. And thanks again. And you can reach out to her. We'll drop her contact information in the comments.
Thanks, Helena. Appreciate it.